Ladies and gentlemen, as you may be aware if you're subscribed to the channel, I own a lot of shares in Altria Group. Now, typically when I discuss this stock, it's only in relation to the core business, which is tobacco and nicotine-based products. However, they have approximately 10% ownership in another publicly traded company, and that's something I think that's worth at least touching on. The other company they own 10% of is Anheuser-Busch Inbev, ticker BUD. Now, the reason I call it exposure is because Anheuser-Busch is in the limelight right now due to some marketing situations involving Bud Light, where they seem to have misunderstood the core consumer of that product to a certain extent. Now, I would like to, before I get into that, give you a small history lesson or a refresher. So, another top beverage brand that had a little bit of a faux pas once upon a time was Coca-Cola in the form of New Coke. So, this was something they introduced in the late 80s, early 90s, basically in response to a loss of market share to other drinks and a sort of reaction to the Pepsi challenge, where they were doing taste tests, blind taste tests of Pepsi versus Coca-Cola, and a lot of people were picking, Pepsi. So they released this new formulation, and the American public reacted badly. It was considered a major failure, and they reintroduced the original formulation, rebranded as Coca-Cola Classic, which ended up, coincidentally, resulting in a significant sales boost. Now, some people speculate that it wasn't a coincidence and that it was actually a ploy intentionally designed to stimulate sales of the original Coca-Cola. The company denies that. And this story is continuing to serve as a cautionary tale against tampering with an established, successful brand. So, what happened with Bud Light? Well, they went a different direction with their marketing, which tampered with an established, successful brand. Their previous marketing, we'll just say, it had a certain je ne sais quoi. You would recognize it as a very light beer type marketing campaign. It seemed very fitting to the tailor-made, so to speak, for the type of individual you would usually see consuming the product. Okay, recently that's not what happened. All right, it seemed like they were marketing to exactly the audience who doesn't generally consume their product, which is a little weird. But you could say, hey, maybe they're just trying to grow the tent of people who drink Bud Light. However, unfortunately, it was done in a way that alienated the existing audience, we'll say. Now, there's this ex-Anheuser-Busch employee that says that it was a strategic destruction of Bud Light. Basically, they're saying it was on purpose. They knew that this would tick people off and create an uproar and all that. Now, they assert that it's mainly for things like being able to justify cutting down on staff, cutting pay, cutting benefits, cutting production costs, etc. Now, that's possible. Now, it could also be something where, like with the New Coke situation, maybe there's a pivot incoming. Maybe even if the New Coke thing wasn't actually intentional, maybe they're trying to pull a New Coke, have a pivot, and drive sales back up. Maybe kind of like a little bit of like a Hail Mary situation. Now, I don't know that, but it's interesting to speculate about anyway, right? It is hard to believe that a company that large, that spends that much on marketing and such, would be so dense as to not realize that this was not the obvious play, right? So was there some intentionality behind it, and what was the real motive? We may never actually know the true answer to that, but I do think it's an interesting it's sort of an interesting parallel to the New Coke situation from decades ago. A lesson in what can happen if you tamper with a established brand. Now, regarding Anheuser-Busch and their financials, well, this is a company that has a lot of debt on their balance sheet, right? So they've been paying it down, granted, over the years, and they may still continue to pay it down. But, it is a concern with this high interest rate environment. Also, the majority of the assets on the books here appear to be tied up in goodwill and intangibles, which makes sense with how many different brands they've acquired over the years. Generally speaking, you don't make an acquisition for exactly the tangible book value of the target company. But I have some issues when it comes to the consistency of their EPS and free cash flow per share. It's really not been terribly consistent, and their dividend likewise has been extremely inconsistent and is at a pretty low point. In fact, it looks like the lowest point it's been at in like 10 years as far as their dividend per share. Not fantastic. I mean, maybe it is that they've cut the dividend in order to facilitate debt payoff or something like that, which maybe that's the good business move. But this earnings per share and free cash flow per share, I am not really sure what their plan is for growing it. And perhaps it would be good to look at analyst estimates at some point. However, when you look at a free cash flow, a discounted free cash flow model, well, first of all, the model recognizes that free cash flow has technically declined over the last 10 years and just gives us really low default assumptions of 5% growth with a 10% discount rate. Now, if we penalize them for their balance sheet, we would have to subtract $40 per share because, again, while they have a lot of assets, a lot of that is goodwill, which isn't something that adds to their tangible book value. So the debt really hurts them in that way. Honestly, personally, I don't think I'd be comfortable buying them at current valuations. They don't really excite me in any way, right? And if I wanted to make an above market return of, say, 12%, I would need almost 10% growth annually in their free cash flow per share to justify that the current price. And honestly, unless you dig into the 10K and give a really, really solid case for how they're going to grow their free cash flow by almost 10% per year over the next 10 years, I just can't get excited about it. I think that there are, if I'm going to accept a lower return, like 9 or 10%, closer to the market, there are companies that can give me that return with a lot more consistency in their free cash flow than what you get from Anheuser-Busch. So that's kind of my take on that position. I've heard rumblings that maybe Altria will just sell their 10% stake in this company to free up cash pay down some of their own debt, maybe use it to expand the distribution of the vaping company Enjoy that they just acquired. So honestly, selling the stake might be the move for Altria Group at this point, especially considering, honestly, the stock has kind of stayed pretty sideways even in spite of this little market faux pas, and is actually up almost 10% over the last year. Honestly, though, like, they crashed really hard during COVID and really have yet to get back up to the pre-COVID levels. So, I mean, honestly, I think if I'm Altria, I do seriously consider just unloading the position and going after greener pastures with all that capital, because that's billions of dollars they could use on something else, or maybe just doing buybacks or something like that. So that's my take on the Altria Group 10% stake in Anheuser-Busch InBev. Let me know what you think in the comments below if you own shares in either company. And as usual, hop into the Discord and we can talk about it more. Be a little patient if you go in the Discord. I don't let people start popping off right away, and that's to avoid spam and scam. As usual, like it, and dislike it if you don't. But if you don't, well, you're no friend of mine. See you later, everybody. Cheers.